Welcome to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business in Toronto, Canada. This video covers accrual accounting basics, and by basic I mean really basic. Here's what we're going to cover today. We're going to have a very introductory look at accrual accounting, just so you understand the basic distinction between accrual accounting and cash accounting. And then I'm going to look at some basic information about how the financial statements link to each other so that you understand the effects of transactions on these statements. With accrual accounting, I want to give you a very simple example to illustrate what I'm talking about, and then talk about the four basic possibilities that exist in accrual accounting. Here's our example, a really rudimentary example. I've just called it Pat's Courier Company. Pat purchases a truck for $50,000 and uses it for 2 years. And the idea here is that Pat bills his customers or her customers $6,000 per month and collects from them the following month. As is normal in a business, you send out an invoice and you get paid later. For fuel and maintenance, I'm imagining that Pat has $1,000 per month in expenses and pays cash for them. Pat's employee is going to be paid a wage of $2,000 per month. That's going to be paid on the first business day of the following month, just for the purposes of illustrating how accruals work in wages. So imagine you work for a month, and then the following day you get paid. Here's what Pat's Courier Company looks like under cash accounting. What I've done here in this table is list all the events chronologically. So the first thing that has to happen, of course, is that Pat purchases a truck. So we have a cash outflow of $50,000 in the first year. Then the next thing that would happen, I guess, would be that Pat would fill up the vehicle with fuel. So you're going to have $1,000 expenditure in the first month, $1,000 in the second, $1,000 in the third, and so forth, for a total of $12,000 of expenditures in the first year and $12,000 in the second. For wages, what we have is employee, either Pat or another person, working for the first month and then getting paid the first day of the following month. So in that first year, you're going to have 11 payments to the employee for a total of $22,000, 2,000 times 11 months. The second year, there's going to be a payment to the employee in each of the months. And in the third year, you're going to get that final payment to the employee on the first day of the first month in year 3. In terms of the money coming in from customers, as we said, Pat bills the customers for the work that is done during the first month and then gets paid the following month. So in the second month, there's a $6,000 payment and so forth. So this is similar to the wages, but it's money coming in. 11 times 6,000 is 66,000 the first year. 12 payments come in the second year, and 1 payment is left over for the third year. This is all the cash going out and all the cash coming in. And what does this leave us with? The interesting thing here, of course, is that you have a very imbalanced view of the profitability of the company. If you look at the totals in the first year, it looks like Pat lost $18,000. In the second year, had a profit of $36,000. And then third year, without doing anything, without lifting a finger, has a profit of $4,000. So this is fine in terms of keeping track of everything. The total is going to be accurate. At the end of the day, you're going to have a $22,000 profit. But it doesn't tell us how the company is doing in year 1 or year 2. It looks like they had a terrible year in the first year and a wonderful year in the second, and then some gravy left over for year 3. Accrual accounting is supposed to address that issue of the inaccurate portrayal of the economic activity of the company. So under accrual accounting, things are done in a slightly different order. Rather than recording the information on the income statement chronologically, what you do is you recognize the revenue of the company at the point at which it's earned, not at the point where you get paid. So in the first month, Pat delivers packages, and that work for the customers, on behalf of the customers, earns Pat a value of $6,000, which Pat then bills to the customer and gets paid later. In the second month, there's another $6,000 worth of work done for customers and so forth. So in that first year, you have $6,000 times 12 months of work being done for a total of $72,000 in revenue. This is irrespective of whether the payments come in on time from the customers. The second year, the same thing happens. You have $72,000 worth of work done, $6,000 in every month. What you do then is you match up with that revenue, with each revenue event, with each month, the expenses that were necessary for Pat to be able to earn that money. So obviously, one of the things that has to be recognized is the fuel and maintenance expense at $1,000 per month for a total of $12,000 in each of the years. Now, that line is no different from the cash accounting line because the expenditure of cash and the recognition of the expense happen to match up. But for wages, you have a completely different situation. With wages, it's similar to the way that Pat recognizes revenue at the point in which the work is done. With wages, the employees are working during that month, and that matches up with the revenue being earned from the customers. So you have to recognize that expense each month. So you have a $2,000 expense recognized in each of the months of the first year for a total of 24, and in each of the months of the second year for a total of 24. And then the truck is what is most different. The truck, we had an expenditure at the very beginning of the company of $50,000. And what we do is we spread the cost of that truck, the expense of that truck, over the years in which the company uses it to earn revenue. So it's spread over 2 years in this case, because that was the plan. Pat decided to buy a truck and use it for 2 years. So you have a recognition of the expense of $25,000 in each of the years. So what does this give us? It gives us a much, much clearer picture of how the company is doing. You have an $11,000 profit in the first year and $11,000 profit in the second year. So from an economic perspective, this makes sense because Pat did exactly the same thing in the first year and in the second year, delivering packages, paying employees, buying fuel and paying for maintenance, and receiving payment from the customers. All of that happens exactly the same in year one as it does in year two. The only differences are the timing of the cash flows. So by recognizing the revenue when it's earned, and by associating, by matching with that revenue, all of the expenses that were necessary in order for the company to earn that revenue, you get a much clearer, much more balanced picture of the profitability of the company. And of course, at the end of the day, it all works out to exactly the same thing. Just as under cash accounting, you have an overall profit of $22,000. So I'd like to step back then and just think about what are all the possible configurations for accrual accounting. Basically, what you have is a difference in timing between the cash going out or coming into the company and the recognition of the revenue or the expense. So what happens with these things is if you just divide it up into a 2x2 matrix. So on the left-hand side, you can see we've got a row for each of revenue and expense. And across the top, you have the different possibilities for the exchange of cash. Now, I'm leaving out the third possibility, which is the cash gets exchanged at the moment that the revenue or expense is recognized. We saw that in the previous slides with fuel and maintenance expenses, but they don't result in any difference between cash accounting and accrual accounting, so I'm not listing them here. For accruals, your basic situations, let's just talk about revenue. You can have a situation where you get the cash from the customer before you've actually done the work. So for instance, whenever you go into a store and put a deposit down on an item that you want to buy later as a layaway, the store is receiving money from you without actually giving you any goods in exchange. And what that does is it sets up an obligation for them that matches the amount of money that they've been given. They have been given some money by you and they owe you that amount of clothing. Suppose you're an engineering company and you're about to design a building for somebody or a bridge. You get a retainer fee up front, and that is money coming in from a customer that you haven't actually earned yet. So that gets set up on the balance sheet as a liability, as deferred revenue. So from the point of view of accrual accounting, the liability gets set up on the balance sheet in the liability section, and the cash is received, but no work has been done. So there's no impact on the income statement at that time until you actually do the work, until you earn that money. The opposite situation would be where you have done some work for a customer and they have not yet paid you. And this is very common in business to business relationships, where you sell something to somebody and they pay you on invoice 30 days later. So this then becomes an asset on the balance sheet. So you have done work, you've given an economic value to the customer, but you've not received payment yet. So that claim on the customer, that ability to demand payment from the customer, is a financial asset to you called accounts receivable. If you look at expenses, you have the opposite situation. So with expenses, if you exchange cash with a vendor beforehand, for example, you pay for 2 years worth of insurance on an insurance policy paid in advance, that policy will last 2 years. You've paid money for that benefit of being covered by insurance, but time hasn't passed yet. So you haven't actually received the economic benefit from it. So that becomes an asset to you. You have paid for something, and the claim that you have on that other vendor for coverage of insurance in this case is an asset to you, an economic asset. You also have the same thing, of course, with property, plant, and equipment over a longer term. You pay for a factory, you pay for a truck in advance, and then you recognize the expense gradually over time as you get the economic value out of that asset. And of course, the opposite happens when you exchange cash after the event. Suppose Apple receives a shipment of microchips from Samsung. It has received those goods, but it hasn't paid for them yet. So it owes the value of that exchange to the supplier and therefore has a liability towards them. And this is, what we refer to as accounts payable. So these are the four possibilities for accrual accounting. They have to do with whether you exchange cash before or after the economic event. I want now to go over some financial statement basics and to show you how transactions affect the balance sheet and the income statement and how you can begin to recognize the type of cash flow that's taking place. What you see in front of you here is the schematic that I like to use that shows the relationship between the balance sheet and the income statement. The balance sheet on the left is shown in a side-by-side arrangement. You have assets on the left, liabilities, and owner's equity on the right. And you can see the retained earnings line here, which is the important one we want to talk about. Retained earnings is the place where the income statement feeds into the balance sheet. So with the income statement, you have your revenue minus your expenses gives you your net income, and your net income gets added each year to the retained earnings. So the retained earnings starts out with a balance that is carried forward from the previous year. And during the year, the income statement accumulates the revenue and expenses and produces a net income number that gets added to the retained earnings. So that is the link then between the state of the company at the beginning of the year and the state of the company at the end of the year. It's measured by the income statement as a change in the wealth of the company right there. Now, the other thing that can happen to the retained earnings line on the balance sheet, of course, is that dividends might come out of that. Now, that's a transaction that takes place purely within the balance sheet. Cash leaves the company and retained earnings go down. But the income statement is the part that links the activity of the company into the retained earnings on the balance sheet. So the formula then is shown here. Retained earnings is always equal to the retained earnings at the beginning of the year, plus the net income, which is revenue minus expenses, minus any dividends that are issued during the year. What you have then is the accounts on the balance sheet are accounts that are always carried forward from the very beginning of the company. They just accumulate and accumulate. They increase, they decrease according to the various transactions, but they always maintain the sum total of all the activity that ever took place in them. Whereas the income statement just records the revenue and expenses for the year in question. So what you end up with then is a set of accounts in the balance sheet that we call permanent accounts because they're never emptied out. And the income statement accounts are always temporary, which means that they were zeroed out at the beginning of the year and they accumulate during the year. And then once the statements are printed with all the correct information from the balance sheet and the income statement, then all those temporary accounts on the income statement are zeroed out. So let's look at how the balance sheet and the income statement are connected on a more detailed level. I want to show you a set of 6 or 7, 8 transactions, just a variety of simple transactions that will show you the kinds of effects that an individual transaction can have on the balance sheet and on the income statement. So some transactions will affect the balance sheet only, and there's a number of possibilities here. One possibility is that the transaction might occur purely within the asset section. So for example, if you used some cash to buy some inventory, you would have cash going down and you would have inventory going up by the same amount. And that is going to have no effect on the liability section, no effect on the shareholders' equity, no effect on the income statement at all. And in fact, it's not even going to have any impact on the total at the bottom. All that's going to happen is you're going to have a different balance in the cash account, a lower balance, and an increased balance in the inventory account. So that's one possibility of transactions there. Another possibility is that you could have exactly the same kind of thing happening on the liabilities section or the shareholders' equity section. So you could have liabilities going up and liabilities coming down in the same transaction, and everything would still be in balance. So an example of this would be when you declare a dividend as a company. When you declare a dividend, you have retained earnings going down because you've taken it out of retained earnings. But the day that the company declares the dividend, the accountants in the company haven't actually gone about the work of sending out the checks. So you end up with a dividend payable as a liability. So the retained earnings would go down on the day that the dividend is declared, and you would have some kind of an increase in a payable. I don't have a line here for dividends payable, but you have something that goes up on the liability side to match it, and everything will stay in balance in that way. Another example, which is fairly standard, you could have a situation where your cash goes down and your accounts payable goes down because you pay off a liability that you've got to one of your suppliers. And of course, this is going to end up with everything staying in balance. There'll be a slightly lower balance in the asset side and a slightly lower balance on the right-hand side with liabilities and shareholders' equity, but everything will still stay in balance. And quite naturally, you have the other possibility, which I'm just going to shortcut here and show you that you could have both of them going up, of course. What might be an example of this? You could have a bank loan. You get a bank loan from the bank and that goes up, and magically you get cash in your cash account as a result of that. So both the asset side and the liability side go up and everything still stays in balance, albeit this time with higher balances at the bottom of each column. So that gives us an overview of all the possibilities that might happen purely within the balance sheet. Now, as we saw in the previous slide, the income statement feeds into the retained earnings line, right? So if you have an increase in your revenue up here, and you have therefore an increase in your net income there, that is going to create an increase in your retained earnings. So that's going to make the equity side of the balance sheet, the right-hand side of the balance sheet, go up. Now, if that goes up, something else has to go up on the left-hand side, or something else has to go down on the right-hand side. So in this case, if we've got an increase in revenue over here that causes the net income to rise, one possibility is that we got paid for it, which would be an increase in cash, right? So you would have an increase here as well to match the increase in the retained earnings. Or we could have an increase in accounts receivable. If we did work for a customer that earned us some revenue, and then we built the company and we saw an increase in accounts receivable, then that would also account for the increase on the left-hand side. And of course, you could have a situation where you've got an increase in expenses. For example, an increase in salaries here by the virtue of some employees working for a month. And if that goes up, you're going to have a decrease in net income, right? Which means that over here, the retained earnings is going to go down. Now, if you have not paid the employees yet, then you're going to have an increase in your liability up here for salaries payable. Your salaries payable is going to go up, your retained earnings is going to go down. Everything stays in balance. Nothing on the asset side of the equation was affected at all. So this is the simple example that I'm going to be using here. It's basically a set of financial statements for a fictitious company called Child's Play Limited. And they've got a balance sheet as of the end of October 2020 and an income statement as at the end of October 2020. But for the sake of argument here, so that I can show you the effects of the transactions, let's assume that we're just after the end of October and we're trying to finalize the statements for the end of October. Accounting entries are made after the fact, right? The events happen and we record them and then we enter them into the accounting system after the fact. So we're past October 31st, but we're preparing the financial statements as at October 31st. So let's pretend that we have a bunch of transactions that took place towards the end of October that we have not yet recorded. So the statements that you see in front of you at this very moment are actually preliminary ones and not the final statements for October 31st. So let's go ahead and enter those transactions and we'll see the effect on the financial statements. Here's the first transaction I want to look at. We've got a transaction up here that is issuing $5,000 of new shares. So let's say that on October 10th, we issued the new shares and we were paid by the new shareholders in cash. So what happens there? We have an increase in cash of 5,000 and an increase in the common shares of 5,000. Remember, the left-hand side of the balance sheet normally has a debit balance. The accounts on the right-hand side of the balance sheet normally have a credit balance. So in this case, the debit to cash is making the left-hand side go up, and the credit to the common shares is also making things go up, but on the right-hand side. So this is the situation that I described earlier, where you have an increase in assets and an increase on the right-hand side. In this case, we have the increase in the cash and the increase in the common shares. If you recall, if you have a very good memory, you would have seen that in the previous slide, the original balance cash was 7,900. So it's gone up by 5,000. The original balance in common shares was 15,000. It's gone up by 5,000. This is a very, very simple transaction that doesn't affect the income statement at all. When you sell shares, you haven't earned anything and you haven't expended anything. You simply sold some shares to the shareholders, which goes directly into equity. So the cash comes into the company and you have an increase in equity in the line of the common shares. Now, this is a cash transaction, so it is going to affect the cash flow statement. Now, I've not shown the cash flow statement here, but think for a second, what classification would you give to this transaction? The three options on the cash flow statement are operating activities, investing activities, and financing activities. So nothing's happened on the income statements and nothing's happened to any of the working capital accounts like inventory or accounts payable. So this has nothing to do with operating activities. And it's not got to do with any new assets for the company. There's no new property, plant, and equipment. So this is not an investing activity. This has to be a financing activity. A second transaction is a purchase of $3,000 of inventory. And what I've said here is a purchase of $3,000 of inventory on account. This means that we're going to receive the inventory, but we're not going to pay for it yet. We're going to owe that money to the vendor. So what have we got here? We have on October 14th a debit to inventory. Inventory is on the left-hand side of the balance sheet. We debit it to increase it. And we have a credit to accounts payable for the same amount, $3,000. You can see the effect of the transactions here. Inventory has gone up and accounts payable has gone up. You have an increase on the left-hand side and everything stays in balance because you also have an increase on the right-hand side. So there is going to be a change in the totals down at the bottom of each column, but the balance sheet will stay in balance. So what have we got here? We got a transaction that had no effect on the income statement at all because there was no interaction with a customer. We haven't incurred an expense yet because all we've done is we've purchased an asset. When we get inventory into the company, that becomes an asset and it only becomes an expense when we sell the product, and that gets recognized up here as cost of sales, but that's not happening yet. All we've done is we've received delivery of the inventory and we owe the vendor for that amount. So what's the overall impact of this on the cash flow statement? We've got no effect on the income statement, but on the cash flow statement, could it be that we've got an operating activity? We do have a change in inventory, which is a working capital account. We do have a change in accounts payable, which is a working capital account. But there is no cash flow. Nothing has changed hands in terms of cash. So there's no effect on the cash flow statement for this transaction. Our third transaction is selling some of that inventory. We're going to sell $1,000 worth of it, and we're going to sell it at a price of $1,200. And again, we're going to sell it on account. So there's three things happening here. One is we have a transaction between ourselves and a customer for a $1,200 sale. And you can see that here. This is the sale right here for $1,200. But the customer hasn't paid us yet. So the customer is going to owe us. So we're going to put that debit not in cash, but in accounts receivable. And you can see the effect of this on the balance sheet over here. We're going to have an increase in accounts receivable right here. And we're going to have the sale showing up here as an increase in the sales account. So that's all fine. Everything stays in balance there because what we have is an increase in accounts receivable. So we have an increase on the left-hand side, and we have a sale, which means an increase in our net income number, which goes up. And that means that the retained earnings is going to go up. So everything will stay in balance for this part of the transaction. There is, however, a second part of the transaction. Let me just clean this up a little bit to not confuse everything. The second part of the transaction is that when we sold the inventory to the customer in the sale transaction, we actually lost one of our assets, which was the inventory itself. So the inventory items have to come out of inventory. So inventory, being an asset, is normally a debit account. So to make it go down, we have to credit the inventory. So that's what's happening here. We have $1,000 worth of inventory leaving the building. So the inventory is going down. And we have a cost of sales. Now, cost of sales is an expense account, right? So revenue accounts, because they increase retained earnings, are credit accounts. Expense accounts, because they decrease retained earnings, have a normal balance of a debit. So we have a reduction of inventory and an increase in cost of sales, right? So the debit to cost of sales is an increase, credit to inventory is a reduction. How does that stay in balance? Well, let's just have a look. What we got here is we have a decrease in inventory and we have an increase in the cost of sales. But what that does is it makes the net income number at the bottom of the statement go down, which means that we have a decrease in the retained earnings over here on the balance sheet. So inventory has gone down, retained earnings has gone down, and everything still stays in balance, albeit at new totals. This is where things get a little tricky. You have to really pay attention to what happens when you've got changes on the income statement, particularly when you've got expense accounts involved, because they go up, but retained earnings goes down. Once again, we have no cash flow for this transaction because there is no effect on the cash whatsoever. So our fourth transaction is to pay a supplier for some of the inventory that we bought. We're going to pay $2,500 to the supplier. So on October 16th, we're going to have cash leaving the company. So that's going to be a credit to cash for $2,500. And that's going to reduce our obligation to the supplier. So we're going to reduce our accounts payable by the same amount. So what effect does this have on the financial statements? We have a reduction in cash. So that's going to reduce the asset side, right? And we're going to have a reduction in accounts payable. So that's going to reduce the liabilities and equity side. So both of these totals at the bottom of these two columns are going to be slightly smaller, but everything's going to remain in balance. There's no effect on the statement of income, no effect on retained earnings. It does have an effect on the cash flow statement, though, of course, because there is a cash side to this transaction. So the opposite side of the transaction from cash is accounts payable. That's a working capital account. So that relates to the operating cash flow section of the cash flow statement. Let's have a look at our fifth transaction. In this case, we're going to collect some money from a customer. So one of the customers that we had previously sent an invoice to and created some accounts receivable has decided to pay us. And they've, to our delight, given us some money, $750 worth in cash. So what that does is it basically cancels out the debt that they had to us. Or from our perspective as Child's Play, it reduces that asset that we had. Accounts receivable was a financial asset because we had a claim on the customer, and that's going to go down. So when we get the increase in cash of $750, we have a corresponding reduction in that other asset, the accounts receivable, of $750. What does that look like over on the balance sheet? We have an increase in cash and a decrease in accounts receivable, and they offset each other. There's going to be no change in the balance on the left-hand side, no change in the balance on the right-hand side. Everything's going to stay the same. And of course, no impact on the statement of income or the retained earnings. What does this mean in terms of the cash flow? Well, we've collected from a customer. That's part of the way that we do business as a company. It's part of our operating activities, so that is an operating cash flow. Transaction number 6. We're going to make a $1,300 loan payment to the bank. Now, if you recall from the previous slide, we had a bank loan balance of $13,000. The bank loan is a liability, it has a credit balance, and we're going to debit that by $1,300, reducing the bank loan balance. And where's that money coming from? We're taking it out of our cash account. The cash account normally has a debit balance, so we're going to credit that with $1,300. And we're going to see then a decrease in cash because we've taken cash out and we've given it to the bank, reducing our obligation to the bank by $1,300. So everything stays in balance. We're going to have new balances down here that are slightly lower than when we started this transaction, but everything will stay in balance. So one of the things that you need to keep track of when you're looking at the liabilities section is which liabilities are related to the operations of the company, like accounts payable, salaries payable, and so forth. Even taxes payable is a part of the operations. But the bank loan is part of the financing activities of the company. So we have here a transaction that involved cash. So we're going to have an effect on the cash flow statement because it's related to the bank loan. That is going to be classified as a financing activity. Transaction number 7 is just a little oddball transaction. We're going to get rid of one of our delivery vehicles. So presumably in the Child's Play Limited, we have a whole bunch of property, plant, and equipment. Some of that consists of vehicles for getting around and delivering equipment and so forth. So let's decide to sell one of these vehicles. We're just going to put it up on Kijiji, and let's assume that we got paid cash because somebody came over one evening to have a look at our vehicle and gave us $4,000 cash, and they took the keys to the vehicle and drove it away. So what have we got here? We have an increase in cash of $4,000 because this person has given us the money, and we have a decrease in our property, plant, and equipment for the value of the vehicle. And you can see the impact over here, right on the cash and on the property, plant, and equipment. So this is a transaction that has no effect on anything except the asset side of the balance sheet. We have a increase in cash and a decrease in property, plant, and equipment. There's no change in the balance there. And of course, there's no change anywhere else. Nothing else changes anywhere on the income statement or the rest of the balance sheet. It is, however, a cash flow, right? We have a debit to cash. So what is this? This is not an operating cash flow because the thing that we sold was not our inventory. It had nothing to do with our regular operations. We sold one of our assets. So this is an investing cash flow. An investing cash flow can be a positive or negative cash flow. If we purchase a new asset, we have a negative cash flow related to investing in one of our assets. If we sell one of those assets, it produces cash for us. We have a positive cash flow in the investing activities section of the cash flow statement, and that's the situation here. The final transaction I want to look at here is one that takes place at the very end of the month. Remember, we made a payment on the bank loan of $1,300, and it dropped in balance from $13,000 to $11,700. But, time passes, and we have to recognize the fact that we have accumulated interest on the bank loan. And one of the things we do as a company at the end of the fiscal period is accrue any interest on our loans that has to do with the passage of time. So even though there's no transaction with the bank in terms of an exchange of value, there is an obligation that we've incurred to the bank because time has passed and interest is built up on the loan. So what we do here is we have a debit to the interest expense. So we're recognizing here that there is an increase in our expense, recognizing the passage of time and the fact that we have now incurred a new obligation. We've received economic value from that loan, and we have an expense related to that for the interest that we have to recognize. And we're just going to stick that in the bank loan. Now, the details for accumulating interest on a bank loan get a little bit more complicated than that. There's a few more accounts that are involved to accumulate the interest. But for simplicity's sake, I'm just going to show it as an increase in the bank loan itself, right over here. And that's fair because all of those little detailed accounts that we would use to keep track of the accumulating interest on the balance sheet, they'd all be added together anyway to be shown on one particular line. It's worth just remembering that these statements consist of a bunch of lines with numbers associated with them, but each line consists of many, many accounts in the background. For example, a cash account that right now shows $13,850, that might be 5 or 6 different bank accounts that are used for different purposes, a checking account and a savings account, that are all added together to come up with that total. So the bank loan that's shown here on the balance sheet is actually a number of different accounts in our accounting system that are all added together to produce this total. So what have we got here? We have an increase in the interest expense, which results in a decrease in the net income. So what's that going to do? We're going to have a decrease then in the retained earnings as a result. So how does the balance sheet stay in balance? Well, remember, we added the interest to the bank loan up here with the $300 right there. So we have an increase up here in the bank loan. And these two arrows on the right-hand side of the balance sheet cancel each other out. We have no effect on the total at the bottom. And of course, there's no effect on the left-hand side of the balance sheet whatsoever. So there's our accrual transaction at the end of the month, at the end of the fiscal year. And we have an increase in the bank loan, a decrease in the retained earnings because of the impact of the expense on the income statement. But this is an accrual transaction. There is no effect on the cash flow statement at all. So let's just try and sum up what we've covered here today. We've had a good look at accrual accounting, and we went through a very simple example. I think one of the things I want you to take away from that is the little 2x2 matrix that I had for you that showed the 4 different accrual possibilities, depending on whether cash exchanges hands before or after the economic event, whether it's revenue or expense. And then we took an extended look at the link between the balance sheet and the income statement, and we went through a whole bunch of different transactions showing the precise effect on the balance sheet and the precise effect on the income statement. In some cases, it affected only one side of the balance sheet with something going up and something going down. In other cases, it affected both sides of the balance sheet with something going up on one side and something going up on the other, or down on one side and down on the other. And in other cases, it had to do with our profit and loss. So there might have been an increase in revenue or an increase in an expense that had an impact on the retained earnings number on the balance sheet. And everything stayed in balance, as we saw. And then the last thing that we covered today was for each transaction that had an impact on cash, we did a classification of that cash flow as to whether it was an operating cash flow, an investing cash flow, or a financing cash flow. I hope that you have enjoyed this little presentation. Hopefully it makes things a little clearer for you. Bye now.
It's all about money, money, money. Ooh, money, money, money. Ooh, yeah. Dollar signs in your eyes. You only wanna make yourself some money.